Good morning, everybody. Chris from Serene Education with my analysis this morning for Wednesday, the 26th of September 2018. Hi, everybody. In front of me, as per usual, I have my matrix open. So if you can just pause the video here and have a squiz to see which of the pairs are showing continuation. So ideally, color across multiple time frames would give us an idea that we could be spending, well, should be focusing more time on those, and looking for ones that are not in alignment, we should just focus less on those. So, looking very quickly over this, you can see there's not a hell of a lot here that is showing a lot of genuine momentum or continuation momentum. There's a lot of pauses or retracements. The most important thing today that we need to be aware of is it's a huge day for both the US market as well as the New Zealand market. The US in the shape of the federal funds rate. These are likely for, well, there's a forecast for an increase of 0.25 basis points from the current 2% to 2.25% this afternoon. Well, I want to say this afternoon, late evening or late afternoon at 7 p.m. That's followed by the FOMC press conference. The Fed Chair Powell is going to be talking. We also have the crude oil inventories. And then this evening, much later this evening at 10 o'clock British Standard Time, we have the official cash rate expectation forecast, and that looks like they're not expecting any forecast increase on that. It currently is at 1.75 and expected to remain at 1.75%. That will be followed by the rate statement, and then after that, around about 11 o'clock this evening, followed by the press conference. So, if you're trading both the dollar crosses and the New Zealand crosses today, trade so with caution. Okay. Especially this afternoon. Okay, and that's purely because of the expected volatility due to these news announcements, the severity of the news announcements. Any interest rate hike or drop is of importance to any economy out there, and none so much than the US dollar. Okay, so it'll be quite interesting to see how things pan out for this particular pair. One might see a reflection of an increase on any dollar crosses. There might be a chance that it might be factored already into price action. There was expected for a multitude of interest rates to hikes this year. So you probably find the traders were more than likely expecting this to follow through. If we don't get one, then that could be the fly in the mud, as you say, and that could cause a ripple or so. But nonetheless, we should see some volume taking place, especially look at the treasuries, 10-year treasuries, 5-year treasuries for the US market as well. Any interest rate hike would see that as a favorable move for any investors to start looking at buying US treasuries, especially 10-year. I think they're around 3% at the moment now. That would then obviously add more impetus, and we could see a flood of buyers or purchasers of US treasuries in particular, if this is indeed the case as we head further into 2018. So, on that news, I'm just going to have a look now at the 4 majors for all our new students who are using the Forex Made Easy template. And first and foremost, we're going to have a look at the Euro US dollar. So, you'll notice that I have my chart open now on the monthly time frame for the Euro against US dollar. This is with the Forex Made Easy template, so a very level entry template for all the newbies, and a good way to start looking at the markets. You'll notice that there's a lot of lines all over my chart, and this is predominantly because I've done my analysis over the previous week or so, leading up till now. And you can see that these lines represent major support and resistance levels or consolidation points in the past, but also the channels represent what price has been doing over a multitude of times. So looking back at time through 2007 onwards, you can see that the price has been moving within a channel. The only time that the channel was not being used or utilized was when price was taking on the 200 period moving average for a number of years here through 11, 2012, 2013 respectively. However, here on the hard right edge, this is where the important part is. You'll see that as we headed into the start of 2018, price was testing both the 200 period moving average but also the channel high point. So at this point over here, we were hoping to see the price breaching this channel high, so we could actually then see a greater movement to the upside towards at least these areas of interest as we headed further into 2018. That failed to materialize as price failed to break above the 200 period moving average, which is also the channel resistance level high point. And then we saw price going into a consolidation point. And essentially what happened was, over time, we didn't see any clear volume that was going to push price back up above the 200 period moving average. So essentially what happened was those contracts started to be closed by those individuals or traders who were holding those positions, because they didn't see any further substance or positive substance for momentum to the upside. Therefore they started to close them or take profit, and what essentially happened was the price rolled over. And it rolled over to a degree, so we were looking for a continuation of that selling sentiment after the February-March support mechanism was breached. We should have been looking back towards the 50 period moving average as a viable target level, which then brings into the equation the previous support and resistance through 2015 and 2016 respectively. That occurred, and since then you'll see that the June, July and August candle have failed to make new lows. August in particular did trade a lot lower than the previous 3 months. However, it still retraced so much so that it actually saw closed above the lows that we saw for the previous 3 months to that. So finding a very strong support mechanism on the 50 period moving average, that then leads the argument that this could be a sign of a hammer, especially the August candle looks like a hammer. Okay, and if you're using a hammer in terminology or Japanese terminology, that means that you're likely to be building something. So we should be looking for bullish upside movement in this case. And clearly that's what's been happening through the month of September. We saw a slight retracement to the start of the month. However, as we've headed deeper into September, we've seen euro strength coming through. Now, ideally, if we are looking for genuine strong bull candle to concur or confirm to us traders that that hammer is a genuine reflection of the underlying sentiment, which is positive, we need to close within the next 4 days above this consolidated point, which is above the consolidation we've seen over the last 3 months, which would then lead more into the to kind of limiting the amount of risk and heightening the probability that we're going to see a greater retracement, and that would then, we could then argue that we could look back towards the February and March low point, or back towards the channel high point, or even the January and February and March resistance level high, or to the 200 period moving average in this case, as a viable target level as we head deeper into the latter part of 2018. Now, this is a euro against the US dollar cross. Today we have Fed rates. Okay, we're expecting, there's a forecast for a 0.25 basis point increase in the Fed rate. That would then mean we're going to see movement on any dollar cross. That includes the euro. The euro is the biggest liquidity provider globally, and it'll be the same for the pound against US dollar. It'll be the same against the US dollar, Swiss franc, and the yen this afternoon. So keep an eye out on any movement. One might expect this. There has been data that we're expecting interest rate hikes probably twice this year, so it could have been factored in. We might see this. We might see a little bit of movement because they were expecting this to take place. Nonetheless, if you are new to trading, it'll be a good time to kind of just stand aside, look to see how price action moves according to a very important piece of data. In this case, the Fed rate data is of importance. Any interest rate hike for any economy is an important statement in its own. So that will have a noticeable reaction on the open market. And if we can look for some sort of guidance, whether in this case we're looking for euro strength, could the dollar interest rate announcement this afternoon have any impact on that? That'll be remain to seen. However, if we don't see any new highs for euro as we head deep into the end of deeper into 2018, then we want to see price thing rolling over, and in doing so we need to see price trading below the 50 period moving average, because below the 50 period moving average, you'll notice that through 2015 and 2016 respectively, there was a lot of hesitation through those years, and when we had a break above that area in 2017, we saw a rally. So if we are to see price testing those 2015 and 2016 and the start of 2017 lows, price has to get through this very strong support mechanism below us for that to occur. And that would mean we have to have some really dire euro data or some very strong US dollar data to give us that reflection. So here, be patient. Ideally, we want to be trading higher than this box to then target those highs, or below this area of consolidation to trade to the downside. Whether trade continues to trade within this box, then one shouldn't be trading, because the actual movement between the boxes is quite erratic. It's not clear cut. And for any of you traders that are trading with small accounts, that is just going to break every single money management rule that you have. So just be patient at times like this. There are going to be other pairs to trade other than this particular one. So there are signs of positiveness. Just be patient enough to see those signs, follow through to give us a more genuine statement of intent, and then we can trade with far better probability of the outcome being in our favor and less risk.